G'day folks, welcome to another weekly general update for the 18th and 19th of February. And in the week just gone, we had more of the same with the US market. Had a couple of intraday dips, but at the end of the day just kept grinding higher and closed on its highs again on Friday night. So this really is incredibly powerful action, but the market is considerably overbought, so we've got to have a correction at some point in time. It's just a matter of from what price and when it will be. So let's just have a quick look at a summary. First of all, just a reminder on the fact that this is general advice and there's the licensing information. So summary for the week: the S&P gained 20 points, which was pretty impressive. The momentum really is extraordinary, but we've got so much mounting evidence of a top. And I've written about those in the past, but in the last week we've also seen Apple put in a significant reversal candle, and we'll have a look at that setup. And also the transport sector is often a leading indicator for the market to top out, and the transport sector certainly looks as though it's just starting to roll over. It's looking a lot less positive than some of the other sections of the US market. Now, the higher this goes, the inevitable correction when it comes is going to be sharper. So that's why the sooner the better that this happens to avoid a more significant correction. But in the medium term, I've still got an upside target of around about 1440. I still think that's the high probability. And it's likely that this market momentum will continue till at least May, and then into June, July, August, which is the summer months in America, tends to be seasonally softer, where the market either goes just sideways on very low volume or may in fact go down. Now, our index, by comparison, lost 50 points, 1.2% on the week, so it went down by about the same amount that the American market went up, and it really was a pretty pathetic performance. And as we'll see from the sector indices, it's really the major resource stocks that are really the worst of the performers. Now, some sections of the small cap resource stocks are going well. Not all, but certainly some. But again, just beware the sharp pullback, because it is going to happen. Now, gold was up pretty mild, $6 on the week, so really it's just continuing to consolidate the gain that we had starting in January. The absence of a more immediate pullback I read as a sign of strength in the market, so I think we'll just continue to see this bit of sideways consolidation before we start to push higher. 1705, which the market has touched so far, or 1671 are the low points that I'm looking at before another strong push. Silver down 40 cents on the week, but also consolidating in the same way that gold is, and I'm looking for major opportunities to buy silver in the low $30 area, and eventually we will see a breakout and a run towards $40. I'm sure of it. Now, copper lost ground in the last week after getting very close to $4, and that performance, which really is a bit of a bellwether for what's happening in resources around the world, is inconsistent with what we're seeing in the chart of a stock like Caterpillar, which is a Dow 30 stock, which is a good indicator of the health of the global resource industry, and it's still incredibly strong. We'll have a look at that chart as well. And also, if you look at some of the fundamental trends in equipment and tyre supply, I mean, it's common now for companies to have to wait 18 months to 2 years to get supply of large truck tyres and certain mining equipment. And when you look at that, and then you look at the trends in the commodities futures markets, you can get a bit of a sense that the futures markets are fairly heavily manipulated and often don't actually bear resemblance to the health of the underlying industry. So wherever I look away from the futures market and the stock market, I actually see a great deal of strength in the resources sector globally. And it's just we're seeing periodic weakness in the futures and periodic weakness in stocks, which are really short term. In the longer term, those trends will play out. So let's go over and have a look at the charts. And we'll start first of all with the S&P 500. And let's just have a look at this on a weekly view, a little bit clearer, so you can see that we're very close to a double top now. We're really within just a few points of a double top. You can see that the S&P is considerably extended above the moving averages, and if you have a look back in history, it never gets too far above it. In fact, this is about as far as it ever gets before we get a correction. So a correction is coming, there's no question about it. So certainly that's what I'm expecting in the S&P. Now if we have a look at the German index, the DAX index, you can see it's also recovered very, very strongly and is also significantly extended. Now that's quite different from what we're seeing in other markets in Asia. And when you look through the individual sectors, it's quite clear that the rebound in the European and the American main indices is really being carried by a strong rebound in the banks. It's pretty straightforward, really, and I'm not sure that that's actually a good thing to be happening, because I don't see that the banks or the financial system is out of the woods by any stretch of the imagination. Now let's just have a look at the US dollar. The normal correlation you would expect is for the US dollar and the stock market to go in opposite directions. That correlation has broken down a little bit of late, but largely the dollar is really just moving in a kind of an up and down sideways pattern at the moment. So there's not really a lot we can determine from there. Now let's have a look at gold. I'll just pop this on a weekly chart, and gold has still maintained the long-term uptrend that it was in. So really there's been a very powerful uptrend that started just after the GFC, and basically that uptrend has held so far. Let's pop that on there. So you can see that we've had a very, very strong run. We got significantly overbought, so we've had a correction. That correction is very much in Elliott wave terms, which I dabble with a little bit, but not a lot. This is really what Elliott wave technicians would call a wave 4 consolidation, and we're getting really a bit of a tightening wedge pattern here, and I think that's all indicating very clearly that we will get an eventual breakout. We'll get a move above 1900, and then I don't know how far gold might go, but I think over the next couple of years I'm expecting gold to go a long way further. Let's have a look at silver. This is on a daily chart. It's recovered very nicely back up to the 150-day moving average. Again, it's also consolidating those gains, and if we had take positions in silver somewhere in the 30, 31, 31.5 mark, I think that would be a very good entry point for silver. Now there's a bit of a difference going on, and this applies to the American stocks. This is the GDX, which is the Gold Miners Index. It covers the 16 largest gold miners in the world, and you can see that despite the huge run in gold, that this index has really done nothing for about 18 months. So lagging behind to an extraordinary level. Let's have a look at the junior index. So this is the junior gold miners, and you can see that it's done even worse in that period. Well, it's probably the same actually on that same period, but in recent times it's moved down. So there is a complete disconnect between gold stocks, particularly juniors, and the actual price of the physical metal itself. Now the good news is that in Australia we've got a handful of really good high quality gold producers, and they've been going great guns. So at least this is one area of the Australian market where we do have an advantage and we're outperforming. Now let's have a look at the Australian market. And first of all, on a weekly chart, this is the main ASX 200 index. As you can see, it looks totally different to the American index and also the German DAX. And we're really struggling. And when we look at the individual sectors, you can see here's materials. It's really been in downtrend for some time, since about April last year, so nearly a year in downtrend. And just in the last 2 weeks, it started to roll over again. So I just really don't know what it's going to take to get the BHPs and the Rios of the world actually a little bit fired up. If we have a look at the banking index, well, the banking index has done absolutely nothing for quite a long period of time. In fact, we've got to go back to 2004 to find an equivalent level where the index had traded up through. So the banking index has just been a shocker. And you can see it's really just tracking sideways, but I believe then we're now just coming into a period where the banks are certainly facing a lot of headwinds, and I think probably are going to be derated by the market. In other words, they'll be given a lower price earnings multiple than what they've had in the past. So you know, I'm thinking that that the banks are probably a pretty good short sell from here. Let's have a look at energy. Energy hasn't really done anything sparkling yet, but a lot of the small junior energy stocks are certainly doing well. But at the index level, which is largely determined by Woodside and Santos, it's really just been going sideways. So all the major resource companies have been pretty disappointing. The actions in the small caps. Let's just have a look at BHP. So you can see BHP pretty much mirrors the materials index, as you would expect. But if we look at a stock like Caterpillar, which is the major American company, as I said earlier, you can see it's really been in a very strong uptrend. We did have a pullback through the second half of last year, but it's back up now and challenging the all-time highs. So Caterpillar looking very strong, and that's certainly contradicts what we're seeing in the futures markets of some of these commodities. However, it is at a double top. It is extended away from the mean, so I would expect a bit of a correction there. Now let's have a look at Apple, and you can see on a weekly chart we got, in fact, let me just go to a weekly chart first. You can see the price had got massively extended above the moving averages, far more so than it would normally do, or it has ever done, in fact. Was way overbought and really due for a correction, and that correction I'm pretty sure started last week, and that really should lead the market down. So that's on a weekly. So we've got a big doji candle up here, which is quite often when the price is well extended is an indication of a top. Let's have a look at on a daily chart. This candle here on Wednesday is about as good a reversal candle as you're ever going to see. The price gapped higher, traded up, and then got absolutely smashed, and was off about $20 by the end of the day. In fact, more than that from its highs. Now we did get a little bit of a recovery on Thursday, but again the US market finished strongly on Friday night, and Apple finished on its lows. So these aren't particularly good signs. And finally, if we have a look at the transportation index, it's just starting to roll over now. You can see the MACD rolling over and definitely losing momentum. So I think the signs are there that we're very close to a top. We've got this continued situation where the US market just keeps grinding higher a little bit at a time, but if we can just get a correction of a week or two, it'll clear the overbought nature of the market, and then I think we can probably look forward to a pretty strong run into May. So that's it for this week. Talk to you next weekend. Cheers.